Good Monday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamonic. How you doing, Dave?
Good morning, Will. How are you?
Good. You want to start with a disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I at Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to help you give you guidance, provide you with advice. There's the disclaimer.
Yeah. So very melancholy day today, D. I don't know. CNBC, and it's 9/11 today. So a day to really reflect on.
Yep.
Thankfully, you and I, both working downtown, we survived that day. But it was certainly life-changing for a lot of people, and always a day to take a moment and reflect on, thankfully, everything we have. So,
yep, for sure. And that we were working at that time on the American Stock Exchange. Will and I were members of the American Stock Exchange, which was right next to the World Trade Center.
So it was
a block away.
4 or 5 buildings away, I think.
4 or 5 buildings away. Yeah, I think that. And as we came in the morning, that's when it happened. So we were both like right there. So very sad. And
yeah, and it changed the dynamic of the city, and certainly everyone's life around the country and the world for a lot of times. But every day it brings me back to some real rough times, and you survive that, you realize you can survive just about anything. So with that, let's get started.
Yep. So let me share my screen. While I'm doing that, as a quick note to anyone joining us for the first time, Will and I, we do these shows in the morning to really help answer questions you may have about the Market Chameleon tools, the data, the analytics. If you have a question, you could type it into the live chat on YouTube. Will's watching it. He'll read them back to me. We also do provide a link to Zoom for anyone who wants to come in and ask their question directly live. So click on that, it takes you over to Zoom. Once you're in Zoom, click on raise your hand. Once we let you in, you could ask us your question. So while we're waiting for more people to join us and to give people a chance to put in their questions, we'll start out taking a look at the pre-market report to see if we could get some insights, what's trading in pre-market hours, and then we'll go to the questions. Okay. So pre-market report, these are stocks trading in a pre-market hours. I'm going to come down here and we have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. Over here, I see 113 stocks made our percentage gainers list, 31 in the decliners. So far from this perspective, looks like the trading in the pre-market hours is leaning more towards the bullish sentiment side. Let's look at it from another perspective. If we scroll up here, we have this calendar view, and this gives us a summary from the high level what's going on in pre-market hours. So today, here, September 11th, we have 540 stocks that trade in the pre-market hours that are higher than the previous close, which would have been Friday, so the previous day's close. We have 182 stocks trading lower. If we look at the volume, the number of shares trading, 106 million shares are trading on an up volume versus 30.6 million on down volume. And if we convert that volume to dollar value, we've got $3.7 billion worth of stock trading higher versus $307 million worth of stock trading lower. So that also indicates that the trading in the pre-market hours so far is trading with a bullish sentiment. One more check we'll do, and then we'll move on to the questions. I'm going to come down here. And when we look at the list of stocks here, you'll see that there are small cap stocks in there. We have ETFs in there, leverage products, closed-end funds. Pretty much any security that's listed on a major US exchange, if it's trading in pre-market hours and meets our thresholds that we set for liquidity, volume, price moves, it can make this list. And to narrow down the list to a smaller group of stocks, we could use the filters here above. If you have a watch list, you can filter by your watch list. That's this filter here. I'm going to use the filter next to it in ETF. When you click on it, you get a drop-down menu with different ETFs to select from. The top one, SPY, that's the S&P 500 ETF. So I'm going to click on that. And when you do that, the list below gets filtered by stocks that are holdings in the SPY ETF. So here, which are the S&P 500 constituents. So here we see 13 stocks made our percentage gainers list, 2 on our decliners. So also from this perspective, looks like it's indicating that the pre-market trading is trading in a bullish manner or bullish sentiment. So we gave it a couple minutes, Will. I guess I'll take some questions. If not, I'll try to look at a question that was remaining from Friday.
Yeah, no questions have popped up.
Okay. So I think someone mentioned a new ETF, TSLY. Is that correct, Will?
Yeah, I'm not sure how new it is, but they've been it's been new that quite a few people on the chat have been participating in it in different ways. Some have been, I think, buy writing against it, and
Right.
yeah.
So, and this ETF itself is related to Tesla here, which is up 6.5%. You could see in a pre-market hour so far. But
I think that was an upgrade today.
All right. So let me just come to that TSLY. I was looking at it briefly in the morning because you mentioned it today, that we had a leftover question. So this is the TSLY. It is an ETF. If we look at it and try to read about it, I think the objective of this ETF is to mirror a buy right strategy in Tesla, right? So buying Tesla versus selling calls, right, for premium. So I think the question was, to take a look at the makeup of it,
Yeah.
how they're doing it, the holdings. And briefly, I just kind of went into this ETF profile, and I did look at their holdings just to get an idea of what's going on. And as you could see here, it's not a simple strategy where they own a bunch of stock and then they have an equivalent number of calls written against the stock. So, that I noticed right away. I'm like, okay, so they are doing something a little bit more interesting in their attempt, right, to be efficient and mirror what a buy right strategy would look like. So here we see they got US Treasuries in there, right? I see call options in there, a little bit of cash in there, and different options, right? I see a put in there. So I did go then to the website just to get like a better idea of what's going on. And this is their website. If you want to get to it, we do have a link, company website over here. And what I did was, look, I skimmed through it, so I didn't download the whole prospectus and read about it. I started kind of skimming through it, but what I did do was come in here and try to download the holdings. So you see here, you have the holdings. We just looked at the top 10, but you can download all the holdings. And that's what I did to try to see if I could get a better picture of what's going on in there. And this is an Excel spreadsheet right now, their holdings, if you download them. So then we got to try to figure out, okay, what do we think, how do we think they're achieving this objective? What are they doing? Because you've got different instruments in here, right? You have a treasury in there. We don't see any stock. So there's no stock holdings, right? Not that we could see, because here, these are options, right? We got treasuries in here, and then we got options in there again, and then we got cash. So we don't see any Tesla shares. All right. You could look, if you look down here, you could see shares, price, market value, and these are the securities. This is the CUSIP. So they don't own any Tesla shares outright in their holdings. They have calls in there, and then they have puts in there too. Right. So that's another thing that's interesting. And then they have treasuries in there. So how do we, take that information and reconstruct how are they doing this? How are they managing this portfolio? All right. And by owning treasuries, right, what does it tell me? Well, if they're holding treasuries instead of stock, that means that they took the cash they took the cash in, and instead of buying the stock outright, what they did was say, okay, we're going to buy the treasuries and use this treasuries as collateral. But by doing that, we're earning extra yield on the strategy. All right. So they decided, let's take this cash, and instead of buying Tesla stock, because if you buy the Tesla stock, you're not going to earn interest on the stock. You own the common shares. And it looks to me like they decided, right, instead of buying the stock, we're going to use treasuries, create a synthetic position. Right. This is what it's looking like to me. We're going to create a synthetic position that looks like a buy right without purchasing the stock, and using those extra cash to hold treasuries. The treasuries basically are going to be their collateral for this strategy. All right. So that's the first thing that appears to me what they're doing. So then how do you create a synthetic buy right? Right. Well, we do see that they have puts in there. Right. So let's look at these two first holdings. This one looks to me like it's a September 15th 265 put. Now, just to confirm it, they did give us a price that they marked it at 17.3. Right. So I'm going to go here September 15th. So I went to Tesla on our options chain. So here's September 15th expiration. And September 15th, which one did I say? The 265 put? So you could see here, 1730, 1745. So they're marking that. Oops, sorry. So I'm going to conclude that that's this put. Okay. So we found the put. Now they have another one in here, October 20th, another put here, 725. Again, we could do the same thing. Go to October. Sorry, well, what was that expiration? October. Because I have a couple Octobers in here. October 20th. So here's October 20th. This one might even cover earnings by our estimates. And on October 20th, it looks like they have the 255 put, 7.25. Oops, sorry guys. I don't have a great navigation between here. The October 20th. Wait, was it the 225 put? $225 put, right? 7.25. So we found that one too. So now, and they got calls. So the first thing, let's come back to here. And it kind of builds on top of the buy right that we were talking about last week, covered calls. And somebody mentioned, isn't a covered call the same thing as selling a synthetic put? And that's correct. So let's take a look at that. So one of their strategies is this put, 265 put. So if you did a buy right, 265, let's put that in there. That's selling the call, right? 265 call. So you're selling the September 265 call, and let's see what the call looks like on its own, right? So on its own, the 265 call looks like this, right? If you just sold the call, if the stock goes down, you keep this, the call will expire worthless, you keep this credit. But if it goes up, you're going to start losing basically, at expiration 1-for-1 with the stock. So a buy right would look like this. You buy 100 shares, right, to cover the upside. And let's calculate that. So here's what the buy right looks like. Here's what the buy rate looks like. If the stock goes up, all right, you make on the, if the stock is below the strike price, which it is here, right? The stock's 348, the strike price 265. So you earn, or you make money on that difference between where you bought the stock and the strike price, right? If it goes above the strike, then you also sold this premium. So you'll collect this premium, and then you're going to get assigned on that strike if it goes above the strike price, right? So that's what this looks like. If it goes down, the stock goes down, well, you're going to lose on the stock purchase, which is offset a little bit by the credit you received for this call, right, below the strike. So that's what a buy right payout diagram looks like. But if you look closely at it, right, look very closely at it, what does this payout diagram resemble, right? What does it look like to you? And it looks equivalent to just selling a put, right? What happens if you sell a put? Well, if the stock, right, just a naked put, you sold a put and did nothing else. Well, what will happen is if the stock moves higher and crosses your strike, right, crosses the strike, well, the put will expire worthless, and you just keep all the premium that you sold it for. But if the stock goes down, what happens is your put at expiration will be the difference between wherever the stock is and the strike, right? So as the stock keeps going lower, your put goes up more and more in value. You have to buy it back for a higher price. And of course, you have that cushion, the premium that you sold it for. So the profile looks identical to selling a put, right? That's what it is. This is synthetically selling the put. So let's take a look at that. So instead of going out and buying the stock, right? Instead of buying the stock and selling the call, they determine, well, it's more efficient. It's more efficient to sell the put. And since you're selling the put, you're receiving money. You're not actually buying anything, right? So now you collected this money, but you didn't purchase anything. So you sold the put, but you still have all this money that instead of buying the stock, they took it and bought treasuries, right? That yield them whatever. Okay, maybe 5.5%, whatever it is, but they did buy treasuries. So they did that instead of the typical buy rate. So let's see how that would look. So keep this in mind. This is what the buy rate looks like, right? We sold the September 265 call for 102. bought 100 shares. So I'm going to close that. And look, selling the 265 put, right? That's all I did. Sell the 265 put, September 15th expiration, same strike as the call we were talking about. And I'm going to calculate that. Let's expand that to 20%. Right? So you could see the payout diagram looks very similar, right? Payout diagram looks similar. Because because the buy rate itself is a synthetic, it's like selling the synthetic put. There's some differences, and you have to see which one's more efficient based on the cost of carry and the interest that you could earn, right? So that plays a big part into it. Well, what is the interest that you could earn on your idle cash, right? Because if you're not doing a buy right, selling the put, if you're not doing the buy right, the typical buying, purchasing the stock, selling the call, that means that you're not using those funds to own the stock. And this is what they're, so this appears to me as part of their strategy is that they're saying it's more efficient to do the synthetic buy rights and hold the idle cash in treasuries, but you could replicate basically the buy right strategy with potentially an enhanced yield. So whatever, if they're earning more in the treasuries and they're using leverage efficiently, then maybe they could do a better job at it than you simply buying the stock, selling the call. Of course, I don't know what their fees are or what their transaction fees are, all that.
You can bet they're probably pretty high, would be my guess.
It might be. I don't know. Right. You'd have to go in there, take a look to see if it actually is more efficient than you just doing it on your own. Because if there's a high management fee, if their transaction fees, the thing with these buyers, and you could see that they're not going out long term, right? They're going out, they're kind of staying within the short term. We're talking about September, October. We're already in September. This is an actively managed position, meaning you're rolling it, right? Anytime you have a high turnover, you have fees, right? The more trading you do, the more fees you're incurring. So it's something, they're actively managing it. I don't know what their transaction fees are, but the more transactions you do, the more fees, right? So if you did a buy rate 1 year out and held on to it, and then rolled it, I don't know, however you rolled it, but this is an actively managed position where you're constantly rolling the options.
Looks like the expense ratio is 1%, is what it's saying.
So there you go. So there's an expense ratio of 1%. Something to consider.
All right, we have that was great, D. Actually, everyone who was talking about it was on and thought it was a wonderful explanation. We have kind of in a different direction. We had a question about Vega from Sarush, and he's on the Zoom. You want to try to take that with 6 minutes left, or hold that off for another day?
Yeah, let me try. Let's see, if I could answer it in 6 minutes.
All right, Sarush, coming in from university. He's taking a moment off to ask a question about Vega. Sarush, thanks for coming in, buddy.
Hey, Sarush, how are you?
Very good. You?
Good, thank you. Thank you for coming on the show.
No, you guys are doing amazing shoots. It's very educational.
Oh, thank you. Appreciate it.
So yeah, I had a little question regarding the Vega that it's used like in the option pricing, especially when we are here to sell them. And I want to know on the Market Chameleon, is there somewhere that we can look how much is too much Vega comparing to the position size that we are taking or to the portfolio that we are managing?
Yeah, I mean, it's a good question. It's really like a risk management type question. So we don't have any tools like that. As far as your, like risk management, and I think that would really, it's, it would apply differently maybe to different people. I think there are a lot of factors involved with that. So I'm not sure even how to answer like what would be too much. I don't know what Will, do you know of any tool that would help
I
with
don't,
that?
I don't off the top of my head, but I would say one man's Vega position that could be terrifying to him is another man's, get up in
Yeah,
the morning and have a
the
cup of
risk,
coffee. It depends on account size and
risk tolerance
how much money
situation.
you're managing. It's a very it's a
Yeah,
great question.
it's it's a great question for a great discussion. Maybe not in like a 4-minute discussion. If we went through some different types of scenarios, and
Right.
examples, maybe it would shed some light on it. You know, like I don't have a quick answer for you. We are doing a show, but by the way, just a reminder, we are doing a show tomorrow with Interactive Brokers on the option pricing model, and I'm going to talk about Vega on that show. So I'll talk about the importance of the option pricing model, the Greeks, different strengths and weaknesses of the option pricing model, how you could kind of, use it, because it's an amazing model, right? And the option pricing model is a great model that you could use to apply towards, those principles towards trading almost anything. So the option pricing model, it's just an amazing model to learn and understand because it guides your trading decisions, and that's very unique, where you could use not just something to price an asset, but to guide your trading decisions, and your risk, managing your risk. So we will be doing that, and I'll touch on Vega, but I'm not sure if I'll be able to answer your question directly.
Well, just to give you an example, so when Dimitri and I were on the Amex, we mentioned earlier, we were discussing 9/11, and we were working on the Amex at the time. That within crowds of traders, there were traders like Dimitri and I tried to keep our risks as small as possible, right? There were other,
Right.
and we even at a lot of the time maybe like to maybe be a little longer fall than shorter, and there were people within the community that would have put position limits on in short, and didn't care about the vol. It was just
Well, yeah,
everyone was different. It depended on how much money they had under management, their risk tolerance, and because those shorter vol positions could, and this happened a lot. People would not show up one day, and it was because the vol exploded and they were didn't have enough money in their account to cover it. So
yeah, and it's a tough question to answer because even standing in a crowd of different traders, people would have different positions on based on some of their outlook and based on other things that they're doing. Like for example, a lot of firms did the dispersion strategy, so they might have a very large short Vega position in an index, but they had lots of Vega in individual stocks that would have made up for a Vega pop, right? So if there was an overall volatility pop in the market, they had positions in there that would have offset any losses in the short Vega. So they were doing the strategy based on dispersions, and those were very successful strategies, as long as you have the tools and the risk management systems in place to be able to monitor and trade that risk. We've seen some places, where the strategy, there were guys there that just like to be short Vega all the time and found places to do that. They were successful, but a lot of them during like the 2008 crisis, that took a lot of them out. A lot of them were short Vega players, continued to be, and it's how long can you hold out, right? How much money do you have in your account? How long can you hold out if volatility is increasing, and Vega is increasing? But usually you have something to offset it, right? If you have short Vega, then usually maybe you have long gamma positions to offset some of that risk. So your gamma would make up for your, right? If your long gamma and volatility increases, then you're making up in the trading while you're losing in the volatility, right? But if you're short Vega and short gamma, you probably were getting, it was like a double whammy, because you're negative scalping your positions, and on top of that, losing on your Vega.
Okay, I see. So this breaks down very much to the risk management and how you treat pretty much each position regarding to the risk.
Right. Yeah, exactly. It's like each position would, your overall portfolio, your risk, it changes over time. It's never, it's unique at every moment and sort of the market conditions. So it's very hard to, answer that question, in general. But usually as a trader, you're kind of trying to work your way back to a balanced position, right? You're always trying to get, how do you work back towards a balanced position, capture an edge?
Okay, and there's not such a rule of thumb, like typically when you are selling options, we're like trying to keep the 50% of the capital always in cash. And there's these rules of thumb going here and there for the Vega. Isn't such thing as the rule of thumb, like, I don't know, a Vega of 350 for a portfolio of 100K, for example. Isn't that a rule of thumb there? Just a general rule?
I mean, I'm not sure. I don't know of a general rule like that. There may be, I don't know of a general rule because, like I said, ours Vega positions, our gamma or Vega, theta, it was all part of a much bigger portfolio. So there wasn't any, if there was a concentration of risk, we would have to actually look at it and say, well, why do we have this concentration of risk? And we would shock it ourselves, to see different, how would it play out, different scenarios, how would they play out? But it was always a bigger part of a portfolio. So it was never, like a concentrated risk that, in the rule of thumb. And our role was really like market making. So our positions could be changed. It was changing intraday, could flip from short Vega to long Vega back to short Vega. So it wasn't like our trading, a lot of it was more passive as a market maker. So since it was more passive, we would try to manage, maybe anticipate order flow and try to hedge it as we're going along.
All right, thank you very much. Super appreciated.
Yep.
Thank you, Sarush, and good luck the rest of the semester. Talk to you later.
Yeah, definitely.
Thank you very much. Take care.
Yep.
All right.
Thanks, Sarush.
Well, that puts us 3 minutes into the opening bell. D. Rob, really quick, he asked the click-throughs that got you to the screen you're on, the TSLY screen.
So I just typed in TSLY up here, and while I was up here, just quickly, I looked at the ETF info here on the About ETF profile, and to get to the website itself, it was under links from a company website, and I just went to the website. And, you could read the prospectus. If you're really interested in the ETF, it's a good idea kind of to read the prospectus. How are they managing the holdings? It's a good idea to be able to recreate that NAV, right? If you're trading it, it's a good idea to read it and try to recreate that NAV if you're trading that ETF. But quickly, that's what I did. Just looked at the holdings from the ETF profile. I read about, and then I went to the company website using this link.
Perfect. We did have a one question. I know Corey was on before and asked, and we may not have answered it. Maybe tomorrow. He's asking about tracking of the trade cards. We track them, but we're 5 minutes in now. Maybe you can answer that for him tomorrow.
Okay. Yep.
All right. Great. Thanks,
that.
D. Thanks, Sarush, for coming in. I know he's studying hard right now, so he made time for our show, which is always great. Awesome job, buddy.
Yep. Thanks, Will. Yeah, and if Sarush, if you learn about a rule of thumb there, let us know, because I'm not aware of one. But if you do, no one, I would definitely look at it and share with the community, but I don't know a rule of thumb like that. Do you, Will?
I do not. No.
Yeah. Okay.
All right. Cool. Awesome job, buddy.
Yep. Thanks, everyone. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
Trade in peace, everyone. Never forget. Bye-bye.